Hello, we will now look at the last leg of the financial system, the financial services industry. In this session, you will learn about mergers and acquisitions, research and advice, asset management, underwriting, specialized financial solutions, sales and trading, market making. Any kind of service offering is an intangible product. Intangible products do not have a physical attribute. If we take the television as an example, the television is a tangible product and entertainment channels are the intangible product. Channels like BBC or Star World are products of broadcasting companies and in turn can be divided into programs, a sub-offering. Similarly, financial services are intangible products offered by financial services companies like investment and commercial banks catering to investors who are willing to invest in the financial markets. In this session, our focus is to understand the different kind of financial services offered to investors. Financial services include mergers and acquisitions, financial research and advisory, underwriting, sales and trading, market making, asset management, and specialized or customized financial solutions. Generally, these services are limited to corporate investors, but some of these services can also be extended to retail investors such as HNIs or high net worth individuals. We will cover each of these components in further detail. We will cover each of these components in further detail as we proceed in this program. Let's begin with M&As. Mergers and acquisitions is a specialized advisory division that provides clients with opportunities to expand and grow, acquire or divest, that sell, and assist them in executing those transactions. While companies can buy or sell divisions and assets by themselves, they often employ M&A specialists to help them identify, value, and close on the right opportunity. The M&A division concentrates on diversification, acquisitions, divestments, recapitalization, and even joint ventures. Corporate restructuring is also one of the focus areas of this division. Next, we come to research. Research is necessary when we talk about finance. Finance is complicated. If investment decisions are not based on thorough research, they are mere speculations and the consequences could be disastrous. Research services include equity research, which includes providing buy, sell, and hold recommendations on listed companies. Fixed income research includes providing recommendations on debt instruments. Macroeconomic research analyzes a wide range of securities, markets, and economies. Economic research analysts provide macroeconomic, foreign exchange rate, and interest rate forecasts. Strategy research analysts provide market views, forecasts, and recommendations covering areas such as asset allocation and investment strategies. Commodities research analysts forecast commodity prices of gold, copper, etc. Industry research focuses on analyzing the investment and growth opportunities of specific industries. Credit research analysts assess corporate debt and cover specific industry sectors to identify and communicate investment opportunities. High-level specialized research provides research and high-level advisory services to policymakers, regulators, and investors. Underwriting has a different meaning in different financial structures. Underwriting is a process employed by investment bankers to raise investment capital on behalf of a corporation. This is done mainly through stock offerings, but may also be done through selling bonds. The underwriter effectively takes a risk by agreeing to buy the security at the established price. In most instances, underwriters will line up buyers for the securities before they take on the security so that it can flip the security to the buyer immediately. The services of an underwriter are typically used during a public offering. Once the underwriting agreement is struck, the underwriter bears the risk of being unable to sell underlying securities and the cost of holding them on its books until such time in the future that they may be favorably sold. In evaluation of a real estate loan, in addition to assessing the borrower, the property itself is scrutinized. Underwriters figure out whether the property is capable of redeeming its own value. Insurance underwriters evaluate the risk and exposures of potential clients. They decide how much coverage the client should receive, how much they should pay for it, or whether even to accept the risk and insure them. Underwriting involves measuring risk exposure and determining the premium that needs to be charged to insure that risk. Under sales and trading, the investment bank disseminates the firm's strategy and research to probable institutional clients, provide actionable investment ideas to portfolio managers at client firms, and markets their securities both in the IPO and secondary markets. The bank also provides feedback to capital market and corporate finance divisions on market dynamics, investor concerns, and deal pricing, thus customizing the final strategy to suit the client's needs. And finally, the bank also develops and nurtures relationships at all levels of the client organization. Asset management is investing and maintaining the client's assets. It is the systematic process of deploying, operating, maintaining, upgrading, and disposing of assets cost effectively. The financial organization will invest on behalf of its clients and give them access to a wide range of traditional and alternative product offerings. This includes products such as equity, fixed income, real estate, agriculture, and international investments. It also includes recommending an approach for integrating maintenance principles and practices with those for asset management and reviewing assets performance and costs, risks, and integrity management. Finally, we come to market making. Market making is a risk absorbing activity. Market making is aimed at infusing liquidity in securities that are not frequently traded on stock exchanges. Market making is a process where a firm that stands ready to buy and sell stock on a regular and continuous basis at a publicly quoted price and thereby providing steady liquidity. By holding an inexplicably large number of given security, a market maker is able to fulfill a high volume of market orders in a matter of seconds at competitive prices. If investors are selling, market makers are proposed to keep buying and vice versa. Market making is like promoting a market efficiently by keeping markets liquid to ensure impartiality for the benefit of their clients. Brokerage houses who act as market makers are legally required to separate their market making activities from their brokerage sales operations. Market makers are not required for security to trade, but their actions can contribute to trading efficiency and liquidity. By matching buyers and sellers, market makers can also help minimize extreme price fluctuations. The market making concept was first adopted in India by the Over-the-Counter Exchange of India, OTCEI, a stock exchange comprising small and medium-sized firms. But the venture failed to take off. Few brokers were willing to become market makers due to inherent risks in illiquid stocks. Also, the market makers were only interested in buying at the lowest possible price and selling at the highest price, which proved to be a deterrent. With this, we reached the end of the session. Thank you and goodbye.